Have the property markets really bottomed? Well, that's a brave call made by my guest today, Stuart Wemyss. Now, if you think about it, this time last year, the property markets were still running full steam ahead. Consumer confidence was high. And you could even get a fixed-rate mortgage with a 2 in front of it. Boy, what a difference a year makes. The Reserve Bank began lifting interest rates, cash rates in May last year in response to rising inflation. And it's kept going right throughout the year. It in fact enacted the fastest series of rate hikes since the 1990s and sparked a dramatic turnaround in our property values. But as our property markets edged towards the end of 2022, prices fell around 7% overall, but by more than 10% in selected areas. Fixed-rate mortgages started to have a 5 in front of them, and buyers could afford to borrow far less than they could a year ago. So how much further are our property markets going to fall? Well, into this new year, the media is full of mixed messages about what's ahead for property, and more of the reliable commentators are starting to suggest we're near the bottom of this property cycle. In fact, as I said at the beginning, my guest today, Stuart Weymss, leading independent financial analyst, believes our property markets may have already bottomed. So I'm looking forward to hearing his thoughts and reasoning behind that. And I bet you are also. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
While there are plenty of property pessimists and even a few credible economists telling us that the property markets are going to keep falling significantly in 2023, leading independent financial advisor Stuart Weymss, founder of ProSolution's private clients, at the end of 2022 wrote a very powerful article published in the Australian newspaper calling the bottom of the property market. Now, I know that Stuart's background as an accountant makes him base his forecasts on data and evidence, not on speculation. And I also know he's had a great track record over the last couple of years, better than most forecasters. So I'm looking forward to his reasonings behind his brave call. Hi, Stuart.
Hey, Michael. Great to be with you for our first podcast this year.
Thank you. Well, it was a brave call at the end of last year, calling the bottom of the market, going in public and doing that. But before we discuss that, I'd like to talk about another great blog that you recently wrote on your ProSolutions website and that you discussed in your Investopoly podcast, one I enjoy listening to every Wednesday when it comes out. And you made a point that the governments have got a vested interest in maintaining property price growth. They don't want to be seen as the new government that's overseeing the latest property price slump.
Yeah, that's right, Michael. And I think it's always good to look into vested interests because it kind of informs you how people might behave in certain situations. And the government is no different here. So, there's obviously different levels of government, federal, state and local government. And they've all got their fingers in the pie. I guess when we think about federal government, there's probably two main drivers for them. Now, whilst we all recognise that a whole bunch of investors enjoy negative gearing, which saves them tax, they do that. That's a short-term benefit to investors and cost to the government. But the long-term outcome is capital gains tax, which is a much, much bigger revenue raiser than what it costs in negative gearing. So obviously there's the government's playing the long capital growth game as well, just like investors should from a taxation perspective. But also, and it's quite important to realise that when people's houses are falling, it has a big impact on consumer confidence, therefore consumer spending, and also therefore economic growth. So if you're going to be a good economic manager and you want to preside over a growing economy, as a government, you really do want to put a floor underneath the property prices to make people feel comfortable.
Another thing that doesn't instantly come to mind, Stuart, is that if you and I provide rental properties. The government in Australia doesn't have to. Overseas, the governments provide a lot more, not just social housing, but general rental accommodation. The government just can't cope with it. We know from the budget last year also that they're talking about providing more affordable housing, but really have no idea how they're going to do it.
Oh, no, it's ridiculous. And this year we'll see a worsening rental crisis. And I'm sure at some point the government's going to turn their mind to thinking, how do we get private investors back into the market to build supply? I'm sure there's going to be some sort of action, probably not well thought out, but some sort of action in that space.
Sure. So one of the things you mentioned was the wealth effect. When we feel wealthy, when we see that the value of our properties go up, when we hear that auction clearance rates are going strong and the properties around the corner are selling quickly, we feel more financially comfortable and we grease the wheels of industry. We spend money, so the government likes that. But also there's the high revenue. We talked about the federal government, but the state governments are particularly dependent upon stamp duty, aren't they?
Well, this is where it really comes to play, because obviously the states are responsible for regulating property advice or property sales, etc. And the federal government doesn't really have any jurisdiction there, which gives us an idea of, why they might want a buoyant real estate market, and maybe why, sometimes people sit back and think, well, shouldn't there be tighter regulation on real estate agents and the like? Well, maybe not, but there's a disincentive for state governments to do that. Depending on where you are, somewhere between 35 and 45% of a state's total revenue is driven by the property market, which is either a combination of land tax and stamp duty. So that's a huge proportion, and is also a problem for the federal government, because if state government revenue drops, no doubt they'll be coming to the federal government for a greater share of GST revenue or something like that. So there's an incentive there for rising property prices, land tax, and also more property transactions, which obviously drives stamp duty as well.
Well, we know that in New South Wales, they've changed the stamp duty rules for first home buyers up to $1.5 million to encourage them to get into the market. Now, that's a very limited market, but I bet other states are going to watch that as well. So the swap is, do I actually pay stamp duty now and a lower land tax, or no stamp duty now and more land tax? And there's a good calculator on the government websites so you can see the difference. But in general, if you're at the upper end of that, it actually is an advantage not to pay stamp duty and get in the market. But what I've found in the past, Stuart, when these things happen, if people have more money in their pocket, it doesn't make properties more affordable. It's actually a benefit to those who are selling their properties, and it just pushes up property values.
It was Rudd, I think, in 2008 that doubled the first home buyers grant, I think, just around the GFC to try and, again, underpin property prices, as a government will want to do. And you're right, all that, you would know fairly well, Michael, all that did is just raise the price on property. It didn't make it more affordable. It just means vendors were probably the biggest beneficiaries of that.
I remember it was called the First Homeowners Grant, but I called it an established homeowner boost, because they're the ones who benefited.
Yeah, that's right. Exactly.
There's also
right.
local governments that make money out of it as well. So there are the three levels of government.
Local governments make most of their money out of rates, and I guess a factor that applies to rates is the rates valuation and then the cents per $1,000, of course. So there's an incentive to keep those values rising. But I think when we look at a local government's vested interest, it really is, and which it really adds to, housing affordability. And I think, it's not lost on me that probably the biggest contributor to housing unaffordability is the government themselves, is the cost to construct or develop. And that's where the local government comes in, quite often. And again, you'll be able to speak far more informed than me, Michael, about this, but the government will force to make open space contributions and, essentially make developers pay for infrastructure. And there's been some studies around, to what extent does government levies and rates and taxes and so forth contribute to the cost of it building a new property? And some of these studies have been done independently by the RBA and so forth. And it's about 30% of the cost of a new home, if you go buy a house and land package or something like that, is is government taxes and GST and all these sorts of things. So, if the government bang on about housing affordability and its issue, and so they are actually the biggest contributor towards it.
Yes, they are. Now, the banks have obviously got a vested interest as well. They own a large part of many people's homes in partnership, I guess, with the mortgage, and they don't want to become mortgagees in possession. So property is too important to fail. But having said that, it's not always going to increase in value. And I see moving forward, there's such an undersupply of not just rental properties, but properties to buy, and with the population increasing and a lot of people requiring accommodation and the cost of accommodation increasing so much. You talked about government charges, but just now lack of labour, supply chain issues, the cost of constructing new dwellings. That's just going to underpin the value of established properties, because new properties are going to have to be brought onto the market at much higher cost than currently actually the market's even prepared to pay.
So the reason, you're right. The reason I wrote the blog is that I sort of sat back and thought about, if I'm going to invest in a particular asset class, and there's an institution out there that has a far larger vested interest in making sure that asset class is worth more in 10 or 20 or 30 years than I do, then doesn't that reduce the risk to investors? And so that's why I wrote it. We can sit here and argue, and I can hear in the background ringing in my head a lot of property bears banging on about, property, you're just saying property is going to keep rising and rising and rising. It's not about that. It's really just about understanding where is the contribution going to come to rising prices. And if you've got a government that has policies and their own revenue dependent on properties rising, well, you can bet yourself that that's exactly what's going to happen. And to my mind, that makes the asset class less risky rather than more risky.
Makes a lot of sense. Of course, the main factors underpinning long-term, as opposed to the short-term ups and downs, long-term property growth will be our rising population or family formation, the requirement, the need for property, and the wealth of the nation, the fact that we can actually afford it. So if you look at other countries with this large population, but they're very poor, many Asian countries, African countries, there's not a queue of people waiting to buy property, but in Australia, it's the opposite. And so we all want to live in much the same locations. So again, we have been around long enough to say that, no, the market doesn't continuously go up, and we have experienced in 2022 what I think is going to probably be one of the shortest downturns in history, but just like the previous boom was pretty unusual also. So again, at the end of 2022, you came out and you said that property values are likely to bottom out very soon. What led you to that conclusion?
Well, I think my first observation, Michael, I'd like to share is that there's really two cohorts that talk about property and property prices. There tends to be, a bunch of commentators and economists that talk about property prices, and they're really looking at macroeconomic data or macro property related data and drawing conclusions as a result. So, one of the more popular conclusions last year was that in 2022, rates are going to rise. So, of course, asset values have to fall and, economics 101. The second cohort of people tend to be people that are in the property industry, that are transacting in particular markets. Now, if I criticise both those cohorts, my criticism would be that the people that are in the property market, buyers agents, real estate agents, etc., are very much influenced by the geographical region that they're operating in. That's their kind of worldview, if you like, and that's not going to represent the total worldview. So they could be in a fantastic pocket somewhere in Australia that's kind of insulated from, any price movements, and they're going to think that the world's fine. And of course, it could be on completely other side of the spectrum. So that's my criticism of property, let's call it property industry people. My criticism of, and let's just call them economists, market commentators, whatever you want to call them, is that they don't think about the behavioural economic factors. That's what I think is the missing picture here. And I know we've both written articles and done blogs on the theme that property is both art and science. So the science bit is the numbers, and the art bit is really understanding the market and getting a really good sense, a taste of the market, if you like. So that's why I call the bottom of the market, because these guys that are commentators are just looking at all these macroeconomic things, but actually on the ground it's changed. Sentiment has changed. Auctions have changed, buyer rhetoric has changed, and that's what they're not going to pick up when they're sitting in their big offices on Collins Street looking at a whole bunch of spreadsheets, just their nose in those spreadsheets, not thinking about the broader market.
There's lots of other metrics that are suggesting the same. So you and I are seeing clients, hearing the sentiment, and at the end of last year, the sentiment did change. There's no doubt that throughout the year, consumer confidence was low and a lot of buyers just put their decisions off. But it seemed like as the year transpired, as the year finished off, people got the sense that we're near the top of the inflationary cycle. They got the sense that we're near the top, not at the exact top of the interest rate cycle, and they started to factor in these in their decisions, Stuart.
Bang on. So that's that would be my first point, is that current prices reflect not only actual interest rates, but expected future interest rates also. Like if I'm going to look at a property today and think, okay, what's going to happen to interest rates in 2023? Maybe there's 1, 2, or 3 more rate hikes. Probably not more than 3. There's probably going to be at least 1. So that gives me a sense of what interest rates might look like, at least for this year and maybe a little bit beyond. I'm going to consider that when I'm thinking about what to pay for this particular property that I'm standing in front of. So we don't need to wait for those rate hikes to occur. They're already factored into current prices. And then the other argument might be from some people, yes, but those interest rates, certainly during 2022, the RBA hiked significantly over that year and we haven't felt the full impact. Well, my counter argument to that would be that over the pandemic period, Australians saved more than $500 billion in offset accounts or savings accounts. And also discretionary spending as tracked by the banks is about still 30% higher than what it usually is. So people aren't stupid. People are sitting back and thinking, I got this free kick during COVID with this really low fixed interest rate for 2, 3, 4 years, whatever it is. I know that that's not the long-term cost of borrowing. It's going to eventually go up. So during this fixed period, I'm going to save some, but also I'm going to treat myself. I'm going to spend a little bit, knowing that when the fixed rate is up, that spending will have to be curtailed. And perhaps maybe they'll have to dip into some of those savings, but that's the whole point of squirreling some money away to save for higher interest rates. So there will be patches of the market that are going to be impacted by higher rates, that might experience higher levels of arrears or defaults. And there's going to be some people that are going to have to sell. There's no doubt about that. But I don't think that cohort is going to be that significant that it's going to have any impact on property prices.
I agree with that, because currently the mortgage default rate is very low. And yes, there are going to be some people that locked into fixed interest rate mortgages a couple of years ago that are going to come out now at a higher interest rate. But we know the banks aren't going to foreclose on them. We saw what they did over COVID, and they're going to help them as well. I think it's also probably worth remembering that we're starting this year with very strong fundamentals. In fact, in some ways, if we compare with maybe 3 years ago, just before COVID started, we're in a better position. Now, there's always negative issues like interest rates and like the war overseas, that there's still uncertainty, and like maybe a recession overseas. But this time 3 years ago, Stuart, the national unemployment rate was around, 5.3%, and today's 3.4%. We've officially got the lowest unemployment rate in 70 years, but there are still around 470,000 jobs advertised with people looking for them. No Australian should feel insecure about their financial future or their jobs like they would have maybe 3 years ago. In fact, I guess it's the first time in a decade that there's significant pressure underpinning wages growth. And as you said, people have saved, they've stashed their cash, they've got more equity in their homes, even though the homes dropped a little bit. I guess the point I'm making is that the fundamentals are good when you look at the Reserve Bank forecasts. Yes, the economy is going to slow a bit, but it's not going to go into recession. We've got a huge undersupply of properties, more and more people coming to the country, and many of them starting off as tenants, rents rising. It's a good way to start the year, Stuart.
Yeah, that's right. If you think about the things that are going to force someone to sell their property this year, it's not going to be unemployment. It's not because they can't go out and get a job. it's really only going to be for two reasons. Either their circumstances have changed, deteriorated, and they can no longer afford their mortgage, or when they did their numbers and purchased, they didn't actually consider the fact that interest rates were going to rise, but the banks certainly would have when they assessed them for their mortgage. So that cohort's going to be small. There's always stupid people that borrow way too much money, and they will get hurt in this environment. That's going to happen. There's no doubt about that. But they're going to be the absolute minority, and not going to have an impact on property prices. The other thing, Michael, is that, and as we were both saying throughout the last couple of years, interest rate expectations can change on a dime. You know, even throughout 2000, I was sort of saying, okay, let's not get taken away in this rhetoric that rates are going to be low for the next 10 years. And, you know, this is some of the sort of commentary that was around at the time. Literally, you can wake up the next morning and the whole interest rate conversation has changed. It will change overnight. It changes very quickly. So at some point, my gut feeling is that interest rate conversation will change this year, probably in the second half of the year, when people start talking about rate cuts rather than rate hikes. Now, I'm not forecasting a huge number of cuts, and they'll probably be slow to push them through, but at least it does give people that confidence that, hey, we are at the peak. If it's affordable today, then in 6 months' time, it's probably going to be more affordable if rates are trending lower.
Now, not only do interest rate expectations change quickly, so does consumer confidence and confidence in buying property. Just look back at March 2020 when COVID hit, everybody started to panic, auction clearance rates dropped, everybody stood on the sidelines until they realised, hey, this is the new world. And look how quickly the boom started. Go back to 2019 after the federal election when, again, there was a significant change in market sentiment, change on a dime, as they say. And I believe this year, when there's been a couple of months when the Reserve Bank doesn't raise interest rates, people are going to suddenly realise, hey, this is as bad as it gets, I better get in the market. And that'll be the trough of the market and the beginning of the new cycle. But I see a window of opportunity at the moment for sophisticated investors who've got a long-term focus, and particularly for upgraders, Stuart, because I believe the upper end of the market has dropped more than medium prices houses. So if you're buying and selling in the same market and you're actually able to upgrade your home, this is a pretty good time to do it.
Yeah, I remember we did an episode at the beginning of last year where I started talking about the FOMO premium, you know, the FOMO premium that was paid really during 2020 and 2021. People that thought, oh, low interest rates are going to be around for ages, I better get in. It's okay to overpay a little bit because if I miss out on this, I'm going to have to pay a lot more in 6 or 12 months' time. And really, you know, prices have dropped during 2022. I mean, we'll see the calendar numbers shortly, but let's say they've dropped 6 to 8%. Well, that's really just the FOMO premium that's come out. People were happy to pay 5 or 10% more than what a property was worth during 2021 in that buoyant market. So that's all that's happened. The problem is no one rings a bell at the bottom of the market, and it never feels like the bottom of the market at the bottom of the market. But you'll only see it a few months after it happens. So when people start to realize, okay, these forecasts of 15, 20% price drops just aren't going to happen, they'll start to see prices stabilize or tick up. And remember, there's at least a couple of months lag in that data, but we'll start to see it. And then that's when everyone will rush back into the market, I think, feeling, okay, we've missed the bottom, let's get in now before prices rise. But everyone kind of thinks the same.
I used to show an interesting graph at the seminars when I was running seminars, which showed the real market and the perceived market. And the real market, what's happening on the ground that you and I are dealing with clients all day, every day, actually is 2-3 months ahead of what's reported in the media and when the rest of the world finds out about it. Now, let's make it clear. We're not suggesting another property price boom. That's not the way it works. It was really unusual in 2020 that we went from a downturn to a once-in-a-generation boom. It was a conglomeration of a whole lot of factors, including wartime low interest rates, historically low interest rates, pent-up demand, government stimulus, and the fact that we couldn't get out and do much else. But I believe it's going to be a stabilisation phase where the people who have been sitting on the sidelines, the discretionary sellers, are going to get in the market, and sellers tend to be buyers. We talk a lot about property investment, but home buyers and sellers make up the majority of the market. So people are going to sell their home, therefore they're going to have to look for a new one, and more stock's going to come on the market, and it's more the stabilisation phase, and then it will move on, but it'll be, I see, a more fragmented market, Stuart, based on affordability. And there are going to be some people who are still going to get hurt, because I think we're going to have highish inflation for a while, highish rents, which means that first home buyers are going to have difficulty getting in the market, stronger cost of living that's not going to be matched by wages rise. So in some areas, there's going to be challenges, but there's also going to be people with multiple streams of income, high incomes, where affordability isn't going to be an issue, especially since they've got a lot of equity in their homes to trade up.
Yeah, I don't predict a lot of growth this year in property markets as a sort of generalisation, but I think there's going to be two factors that are going to sow the seeds for higher growth in future years, so 2024 and onwards. And the first one is rents and rising rents. Rising rents will attract, let's say, discretionary investors back into the market. So when I think about discretionary investors, I'm really thinking about people that really that can invest, that are kind of willing to invest, but they're kind of indifferent. And, because they've already got a decent asset base, it's not necessary, but if there's a great opportunity, they'll of course consider it.
Now, by the way, I don't think you or I are suggesting we should be investing for cash flow, but the cash flow is going to support the properties that give us capital growth.
Yeah, exactly right. So I think an experienced investor will look back and go, oh, hang on, look at these rents rising. Actually not going to cost me as much as it normally does to get into the market. And if your starting rent is your starting rent, rents, they can go down. Typically in really good quality areas, they don't. They tend to be able to hold their value. Of course, they can go down though, but tend to hold their value. It'll start attracting, without a doubt, more and more investors back into the market, even if it's just aggregate rental data, even those secondary areas that are driving higher rental income, they're still going to contribute to that data and contribute to the rhetoric, hey, property shortfalls, so the difference between the cost and the income that you get is contracting, maybe because interest rates will start to move downwards towards the end of this year, but also as rents rise, it'll start to conspire to sort of really attract more investors into the market.
Now, Stuart, before we draw this to a conclusion, I'd just like to find out a little bit more about you and what ProSolution private clients do. Now, you've been a regular on this podcast for quite a number of years now. We get together once a month, and people have probably heard about you, and they can hear in the depth of the information that you give in these conversations that you've been around the block a few times, different to a lot of the new gurus who are coming out telling us what to do with property. And I know we first got together close to 20 years ago when you first started in business. But tell us a bit about what ProSolution Private Clients does and why and how people should speak to you.
Okay, so we inspire our clients to take a holistic approach to building wealth. Holistic in terms of asset classes, so property, shares, super, and so forth, and then holistic in terms of tax and credits and mortgages and financial planning and cash flow, and bringing it all together so that we're maximizing all the opportunities and minimizing whatever risks that eventuate, particularly when you're investing, of course. So what we're trying to do is really be almost a one-stop shop for investors where they can come, talk about their situation, we'll develop a strategy and we'll implement it for them.
And because you don't sell property, I think that's really important. And the fact that you are a qualified accountant, you've got a financial planning arm and a mortgage broking arm, that's actually very different from most people. So the advice you give is, in my mind, not just holistic, but also independent. That's important to me.
Yeah, we've got nothing to sell people other than our advice, of course, but we've got no vested interest in the property market, share market, whatever it looks like. And if people want to learn more, probably the best way is just Google Investopoly. I've got a blog and a podcast that goes out weekly, and it'll give people a sense of, how we think and what advice we give. And if that resonates, then they can reach out.
Sure. Well, I enjoy getting those every Wednesday in my inbox and listening to your podcast. And I have fun having these chats as well. So on balance, the property market is too big to fail. But I don't think anyone's suggesting it's going to fail. But I think the points we made at the beginning of the podcast were valuable. Oh, look, there's always going to be those property pessimists and the trolls who follow us and tell us how wrong we are. But I also agree with you that we're near the bottom. And we shouldn't just rely on one metric. You can't do that. But when asking prices are now stable or rising, when at the end of last year auction clearance rates held up well, when vendor metrics are firm, in other words, days on market haven't dropped a lot, but A-grade properties are selling quickly and vendors don't have to discount much, all that put together, plus the sentiment that we're seeing, would suggest that this is going to be the year of a property market reset. And rather than wait till you read about it, speak to a good consultant like the team at ProSolutions or mine at Metropole. And we often have clients together and because we do very, very different things, and take advantage of this market. Stuart, thank you very much for your time, and I look forward to catching up with you again real soon.
Thanks, Michael. It's been fun.
In a moment, I'm going to share my mindset message with you. But if you got some benefit from my chat with Stuart Weymss today, and he's a regular guest about once every month on this show, if you got some benefit from it and you're not already a subscriber, why not use the follow button on whatever podcast app you're currently listening to us on so that you can get not just Stuart's regular updates, but my show twice a week as well. Now, I just want to clarify that while I agree that in principle we are getting near the bottom of our property markets, and some segments of the market are going to fall further than others, some are going to even out sooner than others, when eventually interest rates reach their peak, and we're not going to have many more interest rate rises this year, when inflation reaches its peak, and it probably has, but there's still some further news that's got to come through, a few more results before we're convinced that's the case. I believe at that stage, more and more people are going to get into the property cycle, and 2023 is going to be a year when the property markets reset and the new cycle starts. But by the way, that doesn't mean that you can just go off and buy any property and make money. The next stage of the cycle is the stabilisation phase. So it's not a boom for some time yet. And then we get to the upturn stage and then eventually the boom stage. But that doesn't mean there aren't opportunities. And I believe that property markets will create significant wealth for many Australians. But statistics show that 50% of those who get into property investment sell up in the first 5 years. And you've heard us say it before. It's true that those who stay in the game, 92% never get past their first or second property. In other words, attaining wealth doesn't just happen. It's actually got to be part of a well-executed plan. And that's why at Metropole, even though we are Australia's most trusted buyers agents and we buy hundreds of properties every year for our clients, we don't do it until our clients have a strategic plan in place. You see, planning is bringing the future into the present so you can do something about it now. So we're at the beginning of a new year. I'm not saying the markets have all bottomed yet, but I believe it's a really good time for you to get your ducks in a row. And by the way, just buying an investment property is not a strategy. It's important to start with the end game in mind, understand what you want, where you want to be, what your time frames are, what your risk profile is, and then to build a plan, to build a strategy to get there. And then the property you eventually buy will be the physical manifestation of a whole lot of decisions that you make. But they've got to be made in the right order. And then over time, many of our clients at Metropole have managed to build very substantial portfolios. I think I've mentioned it to you before that they were recently audited, well, not the clients, but their results, and it was shown that our clients are 7.3 times more likely to own 6 or more properties than the average property investor in Australia. So if you're a beginner looking for a time-tested strategy to get you into the market, or an established investor who's stuck, or maybe you're not stuck, you just want a second objective opinion about your situation, why not allow my team at Metropole to build you a personalised, customised, strategic property plan? Go to metropole.com.au and find out all about it. By the way, it's much more likely that you'll achieve financial freedom because it'll help you define your goals. It'll help see if your timeline's realistic. It'll help measure your current progress, and we'll find ways to maximise your wealth safely by identifying some risks you hadn't thought of. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today I'd like to share with you why being wealthy is very different and much better than being rich. Now, I've learned from mentors, and I still have mentors in many areas of my life. I guess I've learned everything from somebody. We all have. And in the early days, I learned a lot from Robert Kiyosaki, author of Rich Dad, Poor Dad. And while I don't agree with a number of his concepts about real estate, and I don't agree with his thoughts that the financial world is coming to end as we know it, I do like his definition of wealth. You see, many people think that being rich and being wealthy are the same thing. But Robert Kiyosaki taught me that there's a difference between the two. The rich have lots of money, but the wealthy don't worry about money. What this means is that the rich may have lots of money, but they've also got lots of expenses that keep them up at night, or they may have high-paying jobs, but they've still got to go to work every day, and they've got the fear of losing their jobs. There's job insecurity around us, isn't there? On the other hand, the wealthy, they don't have these worries. Why? What's the difference? Well, it depends upon your definition of wealth. And Robert Kiyosaki's definition of wealth was the number of days you can survive without physically working, or somebody in your household physically working, yet still maintain your standard of living. For example, if your monthly expenses are $5,000 and you've got $20,000 set aside in savings or an offset account or money somehow or other, your wealth is approximately 4 months. Or 120 days. So according to Robert Kiyosaki, he thought wealth is measured in time, not dollars. And I can see what he's getting at, because there are a lot of people that are rich but not wealthy because they actually don't have assets working for them. They don't have a business working for them. They don't have systems working for them. So my aim in building my wealth was building a cash machine that would churn out money, but it took time as I built an asset base of income-producing assets. So ultimately, it's not how much money you make that matters, but how much you keep and how long that money is going to work for you. Every day I meet people who make lots of money, earn a lot of money, but all their money goes out on expenses. Every time they make a little bit more, they go shopping. You know what it's like. The money doesn't last out the month. And others who are earning much more and getting higher incomes buy a bigger house or a new car, and they end up with long-term debt and more hard work. They've got non-productive debt. They've got non-income producing debt. Nothing's left over to go in the asset column. And this is the kind of behaviour that separates the rich from the wealthy. Now, like everyone else, I enjoy fine things. I've got nice cars, I've got nice watches, but I don't have to go into debt anymore to purchase them. Rather, I spend the time necessary to be smart with my money. I've worked hard, I've built a business, I've built an investment portfolio that now, today, provides me enough cash flow each month to cover my expenses, including my fun liabilities like my cars and my vacations and my toys. So I don't work for money anymore. My money now works for me. But that takes a long time. It takes delayed gratification. It takes building an asset base that one day will become your wealth machine. So lots of people can become rich, but only financially intelligent people can become wealthy. And that takes a strong financial education. And that's part of what I hope to be giving you through my regular podcasts and my daily property update online magazine. So many people are just playing at getting wealthy, and they've got lots of worries. But if you want to be wealthy, you've got to do things differently to the way the majority of people are doing things. Delay gratification, invest, spend less than you earn, and over the years build an asset base that will give you choices in life. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?